Today's video, we have a special treat. I am actually in downtown Fort Lauderdale with Mr. Andre Walter over at CMG Home Loans. We're going to be talking about their first lien HELOC product, which is the all-in-one loan. We've interviewed Andre before, and this is going to be a follow-up interview, and I hope that you enjoy. Make sure you like, subscribe, and share. And without further ado, let's get right to it. All right, Andre, how are you?
Doing great, Sebastian. How you doing, man?
Thank you so much
Good to see you.
for having me here today, and
Absolutely happy to have you here.
appreciate it, brother.
Yeah.
So, as again, we are in your corporate office here in Fort Lauderdale,
Yes.
and it's been about a year now since you've been with CMG. How long is it?
2 years. Going on
2
my
years.
I'm going on my second year now. Absolutely.
Wow, time flies.
It does. It does
Unbelievable.
when you're having fun and helping people.
Right. So I know you're doing some really good things with
Yeah.
CMG Home Loans, and they have some amazing products. The one product we're going to talk about in particular today, we're going to highlight, is their all-in-one loan, which is their first lien HELOC product.
Yeah.
And so, just tell the audience a little bit about that, and then we'll just dive in.
Sure. CMG has been around servicing the market in the mortgage space for over 30 years now, since July of 1993. And what's really incredible about this company is just the fact that it's constantly thinking about ways to innovate and change the mortgage industry to benefit the borrower and the client. And with the all-in-one loan that we have here, that really does that. It's one of the first first position HELOC opportunity loans that are available in the market today, offering great benefit, allowing people to save thousands of dollars on interest, cut down the time that they are in their mortgages. And I just feel great that I have the opportunity to offer this product to the market.
So I know we've talked about it before,
Mhm.
so when we're talking about a first position HELOC,
Mhm.
what is the difference between a first position and a second position?
Yeah, so the first position HELOC is a loan that is going to take first position. What that means is there's no other mortgage that is going to be in front of that loan. Typically, when someone is interested in a home equity line of credit, it's a second position HELOC, right? And this is a good time to talk about this just because interest rates have been really high lately, right? We've seen, and it's been steady. So people that have refinanced that have lower interest rates are skeptical, right? Well, I wouldn't say skeptical, but they're more concerned about losing the low interest rate that they have now to be able to tap into the equity in their homes. So they're looking for second position HELOCs, right? Because it locks that interest rate that you have on the first mortgage and allows you to tap into the second. So the all-in-one loan replaces your first loan, right? And then gives you a line of credit up to 80% of the equity of your home, and it can stay in first position. So it's extremely powerful that way.
So now, as far as the rates are concerned on a first lien HELOC, how does that compare to a second lien? Is it a little bit higher, a little bit lower?
As it relates to the differences between cost, right? For rate compared to a second position HELOC versus our first position HELOC, I would say that this all-in-one loan has more comparable rates to where your 30-year fixed mortgage is in the market today, where second position HELOCs typically are going to be slightly higher and variable, right? So I would say that's more or less the difference there with respect to where the rates are.
Okay. And so is there a term on this line of credit?
Yes. So you have a 30-year draw period on the line of credit, right?
Mm-hmm.
Which is also a huge benefit compared to second position HELOCs, where they limit your draw period to 10 years typically.
Oh, wow.
I mean, there's some that have shorter time periods, but for the most part, the average is 10 years.
Got it.
Mm-hmm.
So this first lien HELOC basically is going to replace the mortgage.
Yes.
Right? Now, can I buy a brand new property with it if I don't have equity at all?
Absolutely.
You
Yes,
can.
absolutely. Yeah. And it's
Okay.
great because it offers, you can start out realizing the equity, right, in your home very quickly versus your 30-year fixed mortgage, which, is a great product for the market. It's necessary, right? And just to give you a little bit of background on that, as it relates to, 30-year fixed mortgages, it was created to provide affordability in the 1930s. And that's what, was able to close the gap between like wealth disparity between, people that could afford and people that couldn't, right? So And it hasn't changed. The way that you pay a 30-year fixed mortgage has stayed the same since the 1930s. And we're talking about how long is that now? We're in 2024. What's the math on that?
That's almost.
And I'm the numbers guy, right?
1930s,
Yeah,
1940s?
yeah, 1930s, end of 1930s.
So about 90 years.
Yeah, absolutely. So think about it. That 30-year fixed mortgage, the way that the pay structure and the repayment method has been the same for 90 years, and things have changed, right? From then until now. So, and basically when you look at how the repayment structure is for an amortized mortgage, it's interest loaded right in the front, and they do that to ensure that they collect their interest, right? The banks will collect their interest. So, you'll realize that, you're sitting in a 30-year mortgage. Within the first 10, 15 years, you haven't really touched principal. Very little bit is paid. With this loan product, it's a principal first payment, right? So now you have control, right, over your principal balance, which, can save you a ton of money and time.
Amazing. So now if I get a brand new property, then that means, I'm buying the property using the first lien HELOC. And every monthly payment I make, how much of that payment goes over to the available line of credit, and how fast?
To answer your question, Sebastian, as it relates to monthly payments, this program integrates your personal checking account along with your mortgage account, right? Which it makes it very powerful because you're going to be able to maximize the use of your dollars. What does that mean, right? We all make income, right? If you're currently in a mortgage, or you're planning to purchase a home and secure financing, it's assumed that you're employed and you're gainfully employed, right? So you have a certain amount of money that comes into the household every month. That money that comes into the household, what happens is it automatically gets swept over to your mortgage account that creates an available balance for you, right? The benefit of that is that when that money gets moved over to the mortgage account, it reduces your principal balance, and now the interest is calculated on that new balance. Now, if you were to compare that to a 30-year fixed mortgage and you just swept your money over, right? It's going to apply that first amount to interest, and a small balance will be paid towards your principal balance. So the program is designed to eliminate debt fast, right? Eliminate your mortgage balance quickly by maximizing the use of your dollars, right? Let's say, and just to, give you another example, if you're making $120,000 a year, right? Over the course of 5 years, your account is seeing probably more than what your mortgage balance is, right? For them, would you say? I mean, typically. So depending on the average, home price in today's market, we're in July of 2024, it's about $450,000 is what the average single family home is going for in certain areas, right? So with the average home price being at $450,000 in some areas, $120,000 a year over the course of 5 years is $600,000 that's passing through your account, right? Wow. And when you really think about it, the wallet share for most households, 43% of that income is going into the mortgage on a 30-year fixed mortgage that is really just cutting down interest first. Wow. So, that's a poor use of money. So with the all-in-one loan, having that integrated checking account with the mortgage account and having the sweep function allows you to use that money to really knock down the principal balance and save a ton of money on interest and time.
Can you explain that sweep function? So
Sure.
For viewers who don't understand, what does that mean exactly? How does that work?
Yeah, absolutely. So the sweep function is a checking account that the sole purpose of that account is to receive dollars, right? Income. So any income that you have coming in, if you're a business owner, you're self-employed, and you have income coming into that account from the business that you're running, or if you're W-2 employed and your payroll that's coming into the checking account, that money will come into the checking account, and at 11:59, as soon as that money hits, as soon as 11:59 strikes on the clock, that money is then moved over for the best use of those funds, right? Which in this case would be to bring down your principal mortgage balance, so that the interest calculated is now going to be calculated on that new balance, right, of the mortgage, versus, as we mentioned before, if it was a 30-year fixed mortgage, right? The way that the amortization table is set up, if you were to have that same function there, you would be paying interest only, right? And it's locked. And it's
Well, not only that, but then the money would be trapped in the loan at that point,
correct.
in the equity in the walls of the house, versus here, that money it becomes available back on the line of credit. My money doesn't get lost in a loan. It's a revolving account, so I can access that again the next day.
Yeah, and we feel that, yeah, absolutely. That's exactly, and that's the other benefit of the product, right? The other benefit of this program is that it also opens up to 80% of the equity, right, of your home's value, right, on top of that. So not only are you getting the benefits of being able to pay off your mortgage in record time, but you're also having the opportunity to have access to capital because life happens, right? We need money at the end of the day, and our homes are what is really what builds a lot of the wealth here, right? You know,
That's right.
So I think the product is by far the best loan product on the planet as it relates to the real estate market, just because of the function, the ability to allow your money to kill principal first.
Yeah,
is by far the best, I think.
That's amazing. So now I can use this loan. This revolving line of credit, first position HELOC, all-in-one loan, and I can buy a brand new property. It could be an investment property.
Absolutely.
Wow.
Yeah.
Is there a limit to how many investment properties?
There are no limits at this moment.
Wow, that's amazing.
Yeah.
Okay, so literally I can buy a property as I unlock the equity, take that equity, reinvest that in another property, and I can just keep buying new properties with the available equity that I'm unlocking as I am paying off my loan with the first lien HELOC.
Absolutely.
And I don't have to wait 15 years to get all that equity and then apply for a second lien. It's instant access as I'm unlocking.
Correct. Correct. It's instant access, and the beautiful thing about the product as well is that, you know, it gives you full flexibility, right? Not, you know, real estate, definitely. You want to build wealth, you know, that, you know, from what I've in my experience, you know, the fastest way to build wealth, I think, you know, is real estate, right? You can do that very quickly if you're strategic about how you access leverage and what are the terms on it. And there's other ways to do it too, right? I'm not just saying real estate is, but, you know, I think that you don't have to wait to gain access, because right now, let's face it, if you're looking to get pull equity out of a home that you have now, you know, you're up against getting underwritten, right, at your current condition. Now, if we understand that inflation has increased, right? You have debt on your credit cards. You've taken out personal term loans, right? Maybe to kind of ride this wave out to see what happens, right? Your DTI has gone up. You may not qualify. Just because equity is in your walls doesn't mean that you're going to get access to it, right? You got to get qualified for it. Versus if you would have taken out a loan like this all-in-one loan, you will always have access to the equity. I mean, clearly we don't want anybody, you know, we would hate for anybody to be unemployed, right? While you're in this loan, for any loan for that, for that matter. However, this allows some space too, because what will happen in that case, let's just say you fall on hard times and you're unemployed. It will just take the money from the equity in the home to make sure that your payments are consistent.
So this could even be a volatility buffer.
Yes.
You know, that I can access in the event of a rainy day or income loss.
Absolutely. Wow. And there's just so many different dynamics about this product that for me is just, you know, one of the best. And I've dedicated my career to helping clients really maximize, you know, their use of funds, get out of debt, and build wealth, right? And I feel like this product gives you the opportunity.
So obviously, you know, the number one thing, you know, if you have an existing mortgage and you refinance it into this first lien HELOC, obviously it's going to kill that mortgage. But can I use this line of credit, this equity, and pay off other debts as well if I have other assets, student loans, cars, credit cards? You know, would that be a good use of funds to leverage that line of credit to pay off other debts?
Absolutely, it would be. I mean, it's all relative to the current terms that are on whatever the loan is that you're going to be using the funds to pay off. But you know, the way that the product is designed and how it applies the income that's coming into the household to the principal balance, 9 times out of 10, it would prove to offer a better benefit than whatever the current loan is that you're paying off. So
Right.
it could be used for student loans. It could be used for cars, paying off your car payment, right? You know, that has proven to be beneficial time and time again for our clients. And you know,
And you guys in your system, you have a simulator, a calculator
Yes.
where we can like run a scenario for clients so they can see in
Yeah.
real numbers, you know, whether or not it makes sense for them.
This is where it gets really exciting, because now you're able to take a real life situation. You're like, hey, Andre's talking all type of craziness, right? Never heard of something principal first payment. And what is this guy talking about? He has a great beard, but I don't know what he's talking about. We have the ability to show you exactly how it works with using a real life scenario. We can walk you through that today if you'd like.
That's amazing. Yeah, let's do it. Before we go there, though, a couple hard questions that I think need to be answered. The loan rate is not a fixed rate, correct? It's a variable rate. Right?
Correct. Yeah.
So what do you say to someone who says, "Oh, you know, I would never get a variable rate. I'd rather have this fixed rate, you know, that I have now versus a variable rate."
And this is where the simulator really comes in to really illustrate this, right? You don't have to just take my word for it. But a fixed rate mortgage on a 30-year term, right, is very expensive. When you really look at, you know, an amortization table, because of how the monthly payments are applied, it is typically interest. It is interest first. So it's front loaded with interest, right? And a very small portion of that is going to be applied to the principal balance. So you're trapped in this loan longer, constantly paying interest for over 30 years, where this loan product allows you, even though the rate might be variable, right? Because it is, but if you're able to drop your principal balance, then your interest calculations will the interest amount that you're paying will constantly be reduced much faster. So you get to zero fast. If I gave you two options, right? If I gave you an option of taking a 2.5% interest mortgage, right, for 30 years, and it would take you 30 years to pay it off for $300,000, or I gave you a loan at 10%, but it only took you 5 years to pay off that loan, which one would you take? The one that
I'm going to pay off faster because I'm going to pay based. I mean, I'm sure when we see the numbers on that fast 10-year payoff, it's going to show that I'm paying less.
Provided that you can qualify, right? I mean, there's qualifications with this, but just generally speaking, the higher interest loan in that scenario would be it would save you, you would save money on cost, right? You'll get to zero faster.
Yes, well, let's look at a simulation.
We're going to dive right into the all-in-one simulator. This is one of the best tools we have to really illustrate the savings that's available, you know, with this product and other features, right, as well. So, we're at the all-in-one link here, which we'll provide to you in the bottom. I guess where are you going to put this in the
description?
In the description, okay. In the description below, you'll find this link that's available here, right? So the simulator is designed to do a number of comparisons. For this example, what we're going to do is we're going to compare the all-in-one loan to a current 30-year fixed mortgage, right? And we're going to compare the two to show the savings, right? So you'll come to the simulation tab here and you're going to start a new simulation. Pretty simple. You'll come down and you'll say, hey, we're going to look at a rate and term refinance, right? We're going to see if, you know, taking advantage of this loan product, how much is this really going to save me? How much time is it going to shave off of the time I'm stuck in this mortgage? And this is how we're going to test drive it. It's going to be your primary residence. We're going to use new all-in-one loan versus existing traditional mortgage. We're going to come up here and let's just say the home value is $450,000, which we'll put here. And let's just say your balance on the mortgage is $320,000, right? We'll use that. We'll say that this is a 30-year fixed mortgage that we're comparing. And the national average interest rate today, you know, is somewhere around mid 7.5%. But we're going to compare this a little bit lower, right? You're going to compare the all-in-one loan product at a lower interest rate, right? 30-year fixed, and show you how much you can save even with the rate being lower. So we're going to go 5.75%. We're going to say that, you know, you've been in the loan for 12 months, you closed on the house last year, And we're going to say here it's asking for extra monthly payments, right? Now, I'll have conversations with clients and I'll say, oh, I'm planning on making an additional monthly payment to my mortgage, but it's, life happens and it can be very inconsistent. And that's one of the major benefits with this first position HELOC is that it happens automatically. It's a part of the program, right? So if we study behavior and we know that sometimes you might make a monthly payment and maybe you won't, another time, then it's probably best to leave this zero because it won't give you an accurate calculation, right? With the all-in-one loan, when the money comes into the account, it automatically sweeps over. So that is just something that is consistent. And that's what's going to give you the true benefit of the product because you are constantly reducing that principal balance with the income coming into the house. So, and when you compare this to strategies that I've seen with people using second position HELOCs to try to accomplish the same goal, what they run into is just the headache of trying to move money around, right? And time it properly, where this is automatic. You kind of just set it and forget it, right? So deposits. So let's just say you have a household that generates, you have two income earning household, $100,000 or $120,000 a piece. But we'll just say there's, two household income at $60,000 a piece. We'll use that as an example. So we'll say that it's a total deposit of, we'll say $5,000, right? Oops, excuse me. $5,000, and we're going to say that that deposit is done semi-monthly, right? We'll say the 1st and 15th, or the 15th and the 31st, however, or the 15th and the 30th, right? We'll also explore the option of potentially, let's just say you had money sitting in your money market account, savings account, and the interest that you were earning with that money sitting in that account, let's just say it was less than the savings that you could save with this product. It may make sense for you to move that money over to the all-in-one loan because you're saving all that interest, right? So let's just say you wanted to experiment and just say, what if I just move, let's say you had 100 grand, I'm just gonna move $10,000 over, right? And make a one-time deposit. Here it just breaks down what your average monthly deposits are. It shows the average annual deposits, right? And then it shows a one-time deposit that you've brought over into the account to help kill that principal balance, right? Now remember, if you were to take, $100,000, $10,000 and move it over to your mortgage account, your current mortgage, 30-year fixed mortgage, that $10,000 is gone. You might have reduced your principal balance, but you're not going to be able to gain access to the money. Remember, this product gives you an open line of credit for 30 years, up to 80% of the value of the home, so you actually realize the equity a lot quicker. All right, so here it's going to break down what your average monthly deposits are, and it's going to compare the principal and interest on that 30-year mortgage and taxes and insurance. Now, we could leave this here, but I don't know if this is really realistic in terms, especially in South Florida, where insurance has been pretty high lately, right? So let's just say an average policy, and this is for your escrows, your taxes and insurance. Let's just say an average policy is at $7,500, and let's just say your taxes are also $7,500. So we'll use $15,000 as escrow for the year, and we're going to just divide that by 12 to make things easy. And that gives us a $1,250 payment. Now this is high, but this is a reality for most, right? So $1,250 in your escrow payment. So your mortgage, according to this screen here, based on the information that we've put in, per month is going to be all in. Let me just 77, 1250. We're at 3141.77. That's a reasonable mortgage, right? Like that's reasonable to believe. Let me rephrase that. I don't know that that's reasonable for $320,000 because of where we are, but I'll tell you that it's reasonable there, that calculation is accurate, right? Now, after you've paid for all of your expenses, including, going out to dinner, your groceries, your car payment, all of that, let's just say, you are retaining about $2,000 a month, right? Give me 1 second here. I'm sorry. I have to do it based on percentage, right? So let's just say you retain about 20% of your income, right? It's $10,000 an annual, $10,000 a month in income coming in, $120,000 a year. You're saving about $2,000 a month, right? That money will sit in the all-in-one account, right? That's where that money would sit, right? We're going to calculate the results now. System thinks. Now, given the current scenario, right, that I presented, you're currently in a 30-year fixed mortgage that you've spent 1 year in already, right? It would take you 29 years to exit because you're on a fully amortized mortgage, right? Fixed for 30 years, where this product allows you to benefit from the household income and reduce that principal balance every time that deposit comes into your checking account. Because it's swept over, you are going to be paid off within 10 years. Your mortgage is paid, and you're saving over $171,000 in overall interest costs, right? To me, this in itself is incredible, right? On top of being able to have access to the line of credit as well. So, this is a simulator that we have available here on our website. Sebastian will provide the link below. It's a great place to come to just kind of get comfortable with the product, take a look and see, test drive it, and if you have any questions or concerns, listen, I'm always here to help you and walk you through it.
Yeah. Awesome, Andre. Well, I think we've given a lot of value for anyone looking at a first lien HELOC.
Absolutely.
Please submit your request in the description below. I'll be able to put you in touch with Andre directly and schedule a call with Andre and his team. You can run the simulator on your own if you'd like, or on that scheduled appointment with Andre. Andre is also fluent in CMG Home Loans other products. So when you talk to him, it's not a cookie cutter conversation. He's going to look at your situation. He's going to try to help you in the best possible way based on your circumstances and your needs. So feel free to take advantage of that free consultation. And as well, make sure you have subscribed to the channel. Make sure you like and share this video. Please help me to push this out there, make more people aware of this product. Again, remember, you can use this for a brand new property, for an investment property, to refinance and get out of the existing mortgage into a better product so you can pay off that debt faster, free up your cash flow, and redirect that cash flow to wealth building strategies. All right, I look forward to talking to you on a one-on-one. Take great care, God bless, and make it a great life.